Hello everyone. In this video, we'll walk you through the process of designing a trading strategy.
We will not focus too much on the strategy itself, instead, we'll put the emphasis in demonstrating the tools available for you to build your own.
We'll work with a strategy we call the Bull Run Rider, based on the Tether Bitcoin pair, standing on Tether.
The goal is to capture profits from major Bitcoin rallies, so we'll be buying Bitcoin as rallies start, and buying back USDT as rallies dwindle.
We'll use the Bollinger Bands and percentage bandwidth indicators only, and we'll run simulations on the hourly charts.
Let's start off with a few basic definitions. As you may know, strategies are framed around the Super Algos protocol. If you're not familiar with the protocol, please refer to the articles linked to in the description of the video.
Your trading system features parameters, one of which is your base asset, in our case, USDT.
You will also define your initial capital, the total capital available for trading. Minimum and maximum capitals indicate the balances at which all trading stops. Think of those two parameters as an emergency stop in case something goes awfully wrong.
When you create a strategy, icons representing each of the phases determined by the protocol appear on your workspace.
Phases are nested around the strategy, ordered in a clockwise direction. For the time being, you may delete the close stage, as it is not yet implemented.
The designer automatically organizes icons in the workspace, unless you decide to pin them and create your own arrangement.
In order to run the first simulation, you will need to define situations, conditions, and formulas for at least the following. Trigger on event, trigger off event and take position event in the trigger stage, along with the position size and rate, initial stop and initial take profit in the open stage.
So, let's go ahead and do just that. We are going to trigger on the strategy when the ticker price goes above the upper band.
Put in terms of the Super Algos protocol, the ticker price going above the upper band is the situation in which we wish to trigger on the strategy. To do this, we'll go to the trigger on event in the trigger stage, create a situation, and then create a first condition which will describe the situation in mathematical terms.
Now let's build up the code that will define the condition. The variable candle max refers to the maximum value of the current candle at the moment of execution of the algorithm. We need to check if the value of candle max is greater than the value of the upper band.
As a result, our code is, candle max is greater than the Bollinger Band moving average, plus the Bollinger Band deviation.
The variables we are using here and the rest of the variables we will be using along this tutorial, are documented in our GitHub repositories, which are linked to in the description of this video.
As dictated by the protocol, we will now set up the situation and conditions for triggering off the strategy.
In our case, we know the opportunity is cancelled out when the candle closes below the moving average.
So our code will be, candle close is lower than the Bollinger Band moving average.
Next in line is defining the situation in which we wish to enter a trade, that is, the take position event.
We already determined that the strategy will be triggered on when the ticker price goes above the upper band deviation. For actually taking a position, we will want to have a few confirmations that the market seems ready for a rally.
So, we will likely define several conditions that need to be true before the situation is confirmed. We'll start with checking that the ticker price has gone above the upper deviation band for at least 2 consecutive periods.
To do that, we will create 2 different conditions. The first piece of code will check that the price has gone above the upper band in the current period, which will require the same code we used to trigger on the strategy.
That would be, candle max is greater than the moving average, plus the Bollinger Band deviation. For the second condition, the code is very similar. The only difference is that we will use the previous modifier, to indicate that we are checking the previous candle.
This is how it works, candle previous max is greater than, Bollinger Band previous moving average, plus, Bollinger Band previous deviation.
Before working with the rest of the conditions for the take position event, let's jump to defining the mandatory elements of the open stage so that we can run a first simulation.
But before we do that, let's take a second to save what we've done so far, by clicking Save on the Trading System menu. Now we'll go to the initial definition icon within the open stage, and add the missing items.
4 main icons will pop up on our workspace: position size, stop, take profit and position rate.
The position size formula determines how much capital we are going to put in each trade. This could be expressed as a function of your capital, or in any other way. We will use all the available capital in every trade. Our code is balance asset B.
To work with our initial stop, we first need to add a phase. Remember, the Super Algos protocol allows managing stops and taking profit in phases. For the time being, we will set the formula for phase 0, which is the stop we will set up as we take the position.
In our case, we will allow a margin for a 2% loss, meaning that if the market moves against the trade, we will stop when the ticker price drops 2%.
Our formula will then be position rate minus position rate by 0.02.
Because our strategy is about catching big bull runs, and we know how volatile Bitcoin can be, we will set our initial take profit with a ridiculously optimistic target.
Remember, we will later manage the take profit as the trade develops. Our initial target will be a 25% win, so our formula will be position rate plus position rate by 0.25.
Now, the last setting at this stage is the position rate. For the time being, positions are taken with one single order.
In our case, the formula will be the variable ticker, meaning that we will place the order at the latest ticker price the algorithm gets from the exchange at the moment of execution.
Awesome! We just got through the first round of settings, and we are ready to run our first simulation.
Let's pull down the bar and hit Run Simulation. Without further ado,
we will be backtesting from April 2019 and onward, when the new 2019 Bitcoin bull run started.
Once the simulation layers are loaded, we will be able to see the first few trades. But, bear in mind, the system will keep calculating in the background, so we may want to refresh the layers a few seconds later.
This first trade seems awkward. We take the position, and then the market moves sideways for a long time, for what looks like over 40 periods. Yes, the market then shoots and the trade ends up being unbelievably good, hitting the 25% target, but we'd rather not have a position open for so long in a market going sideways.
The ideal case scenario for our strategy would have been to exit the trade much earlier, and hopefully catch the big move closer to the rally. We'll look into this later on. In the meantime, we just make the obvious note, we need to manage the take profit target, so that trades like this don't remain open for so long.
Let's take a look further ahead. Here, we have a losing trade, or what we refer to as a fail, in the simulation panel. At a glance, this trade suffers from a similar deficit as the previous one. It remains open for too long, until the market reverses. We could have taken a profit in at least 2 occasions if we had managed the take profit target properly. Noted.
We keep looking ahead, and find another fail. This time, the trade looks a lot more reasonable at a glance. We are not going to stop to analyze the take position event as of yet. Let's leave that for later. The point, again, is that we need to manage the take profit target.
This other trade is so long we can't even get to the end of it. So, let's just stop here and go back to work on the most evident next step, manage take profit.
To manage take profit, we will define the situation in which we wish to move from phase 0 to phase 1.
The extremely optimist target we set initially allows room for sudden and powerful market moves. However, if once in the trade the market doesn't move up in a dramatic way, then we will want to lower our target.
We will switch phases when the market features 2 consecutive lower highs candles. To define such situation, we will create 2 conditions.
The code for the first one will be, candle max, is lower than candle previous max. This means the high of the current candle is lower than the previous one.
The code for the second condition will be, candle previous max, is lower than, candle previous max.
By using the previous modifier 2 times, we are checking 2 periods behind the current period. So, this code means that the high of the candle before the current one is lower than the high of the one before.
If the 2 conditions are true at the same time, then it means that we had 2 consecutive lower highs, and that we are switching gears to phase 1.
Great. Now we need to define what the take profit formula for phase 1 will be. We will go to the manage stage, add the missing items, and add a take profit phase.
Our formula for take profit phase 1 will be, Bollinger Band moving average, plus, Bollinger Band moving average times 0.125.
As you can see, this time we will not use a static value. Instead, we will relate our take profit to an increment of the moving average. Needless to say, we are still being highly optimistic about the trade.
Now, let's pull the charts down, go back to April 2019, and hit Run Simulation. We'll refresh the simulation layers and see what we've got.
It seems like phase 1 kicked in right after the position was taken in this first trade. It looks okay at a glance, we'll look closer later on.
Also, the ticker price hit our take profit earlier than in the previous simulation run.
We can see a new position was taken right after closing the first trade.
And, again, take profit phase 1 kicked in right away, as 2 consecutive candles closed with lower highs. However, yet again, the market goes sideways and, even though our take profit is lower than the initial one, the trade is not closing as it should.
This means we will go back to the designer and create a new phase, to keep managing the trades in such cases. Our strategy is to keep gradually lowering the take profit until we see clear signs of exhaustion. When that happens, we will be a lot more resolute in closing the position. Once again, we will define the situation that will take us to the next take profit phase, this time too, with 2 conditions.
To switch from phase 0 to phase 1, we checked for 2 consecutive lower highs. This time we will check for 2 consecutive lower lows.
This means that the code for the first condition will be, candle min is lower than, candle previous min.
The code for the second condition will be, candle previous min is lower than, candle previous min.
The formula for take position phase 2, will be similar to the one we used for phase 1, only that we will lower the increment over the moving average from 12.5% to 10%.
The formula is, Bollinger Band moving average, plus, Bollinger Band moving average times 0.1.
Good. Now we go back to the charts, and run the simulation once again.
Let's see. In this first trade, the position was taken earlier than in the previous round. This is because we ran the simulation at a slightly earlier date. I will get back to this concept of the simulation date time later on.
For the time being, let's focus on the take profit phases. We can see that phase 2 was triggered correctly. Fine.
What about the second trade? It also seems that phases are kicking in fine.
Excellent. Okay, for the next round, we will assume that the trade is somewhat maturing. We have already seen 2 consecutive lower high candles and 2 consecutive lower low candles. We will take this as a sign that the rally's momentum may be dwindling. However, a continuation is still totally possible, so we want to allow room for that too.
At this point in time, there are 2 different situations in which we would want to move closer to closing the trade, thus, further lowering the take profit target.
The first situation is in case we are already making a considerable profit. We will simply check if selling at the current price would make us at least a 13% profit.
The code will be, candle close is greater than, position rate, plus, position rate times 0.13.
For the second situation, we will analyze a measure of momentum. If a closer look at the percentage bandwidth indicator tells us that momentum is residing, then we will want to switch phases too.
We will set 2 conditions. The code for the first one is, percentage bandwidth direction equals down.
Pay attention to the syntax. We use 3 consecutive equal signs to write the equation. Please refer to the documentation linked to at the description of the video for an explanation on how the percentage bandwidth indicator calculates directions.
The code for the second condition will be, percentage bandwidth moving average is lower than 70.
So, if any of these 2 situations evaluate to true, then we will lower the take profit target a bit more, from 10% above the moving average, to 8.5%. This will still allow a margin for a continuation movement.
Our new take profit formula will be Bollinger Band moving average, plus, Bollinger Band moving average times 0.085.
Awesome. Let's go back to the charts and run the simulation once again.
Let's take a quick look at this first trade. At a glance, it seems like phase 3 is not kicking in. We will leave this one for a moment and take a closer look at the second trade.
In this case, take profit phase 3 is kicking in as expected. Let's use this opportunity to see how the validation of conditions and situations to trigger each of the phases work.
We split the screen so that we can see the charts and the designer simultaneously. We will position the workspace so that we can test the situation for switching from phase 0 to phase 1.
Remember, the situation checks for 2 consecutive lower high candles. This is why phase 1 kicks in at the candle that follows.
Let's take a look at the switch from phase 1 to phase 2. This time we were checking for 2 consecutive lower lows.
Finally, let's see which of our two situations triggered the switch from phase 2 to phase 3. The candle previous to the switch closed at a rate 13% higher than our position rate, so our first situation evaluated true.
So far, so good. Let's proceed to work on our final take profit phase.
We will use a similar reasoning as with the previous phase. If we find signs of momentum deteriorating, we will switch gears.
We will use the same 2 conditions we used on the previous phase. Percentage bandwidth direction is down, and percentage bandwidth moving average is lower than 70.
Our new take profit formula will be Bollinger Band moving average plus Bollinger Band deviation.
This means we will be taking profit at the upper band level. Let's go back to the simulation and see how this plays out.
Wow! It seems like we finally hit the nail on the head. Things finally changed with the first trade.
It seems we achieved the goal of cutting it down a lot shorter, lowering risk and making it a lot more reasonable.
How about what used to be the second trade? Sweet. 22% profit.
Current phases seem to work great for this particular trade.
Now that our fourth take profit phase seems to be achieving the goal of taking profits as trades mature, we will spend some time analyzing how the current settings work with the rest of the market, up to the present time.
We see a few small hits as well as a few fails. This one in particular starts pointing us to the need of managing our stops.
For a moment, the trade was winning around 2%, but the market reversed and we ended up losing 2%.
A few more hits and misses. This one seems worth analyzing.
It's an almost 6% win, and take profit worked beautifully, catching the very last move to the upper band before the price crashed and went below the lower band.
Well done for take profit, yet, things could have got ugly if that particular candle hadn't made it to the upper band before the price crashed. Again, a clear pointer to the need of managing stops.
Another big win at almost 11%, with take profit phase 4 working its magic.
In this one, we missed the best spot for taking profit. Also, our stop should have caught that big correction, as it could have got a lot uglier.
Here we missed a very sudden rally. Notice how price was at the moving average level, and shoots way up in one single period. These moves are very hard to predict.
This one is interesting too. We are catching the whole move, fragmenting the trade in multiple parts by taking profit every 20 to 25 periods.
Many trades. The strategy, as is, seems to be quite active.
And another 20+% win. Okay, we are almost reaching the present time. Overall, the strategy looks promising, catching many of the big moves.
However, we've seen lots of fails too. Let's take a look at the final numbers.
According to the trading simulation panel, we've done 65 trades, with 32 hits and 33 fails. That is almost a 50% hit ratio. It's not bad, and it may improve once we start fine-tuning our take position events, trying to filter out some of the failed entries.
Our ROI at 194% seems impressive, but it may be unrealistic. By not managing our stops, we are taking a huge amount of risk. The current settings may have played out fine in such a massive bull run, but it would be crazy to leave stops as they are now, so let's go and fix them.
We will switch to stop phase 1, when we have some indication that the trade is going in our favor.
Our code will be, candle previous close, is greater than, position rate, plus, position rate, times 0.01.
This means we will switch phases when we are winning by 1%.
Our phase 1 formula will be, position rate, minus, position rate, times 0.01, that is, 1% below the take position price.
We will set the condition to switch to phase 2 right away, using a similar criteria to the one we used before.
We will switch again when we are winning by 1.5%.
The code will be, candle previous close, is greater than, position rate, plus, position rate times 0.015.
The formula for stop phase 2 will be, Bollinger Band moving average, minus, Bollinger Band moving average times 0.015.
This formula allows the stop to rise along the moving average, more precisely, 1.5% below the average.
Now, let's see how the new simulation plays out.
It's looking good. Our stop now rises right below the moving average, protecting our profit, apparently, as expected.
Here, however, there seems to be an issue. The stop is raised when switching to phase 1, but goes back down when switching to phase 2.
This is probably because the moving average didn't get to rise quite as much in these particular cases.
It certainly is undesirable for the stop to ever go down. To fix this issue, we will replace our phase 2 formula with a slightly more elaborate piece of code.
We will introduce the concept of conditional statements.
Put in other words, we will check if the new intended value for the stop is greater than the previous stop value. In case it is, then we will go ahead and use the new value. If it's not, then we will leave the former value as is.
The syntax we will use to implement the conditional statement is the following.
If, condition, between brackets, formula in case the condition is true, all between curly brackets, else, formula in case condition is false, again, between curly brackets.
So, our formula will be, if, open bracket, Bollinger Band moving average, minus Bollinger Band moving average times 0.015, is greater than stop loss, close bracket, open curly bracket. Bollinger Band moving average, minus, Bollinger Band moving average times 0.015, close curly bracket, else, open curly bracket, stop loss, close curly bracket.
We will go back to the simulation and test the new formula.
Looks good. Indeed, it seems to be working fine. The stop is no longer being lowered. Now, let's run the simulation for the whole period and analyze how things are going.
This case shows why keeping risk in check will likely result in less ROI. If we hadn't exited with the stop, the trade would have hit the take profit 4 or 5 candles later. Remember, it is up to you how to manage risk.
This is a similar case. After the sudden drop, the price went up, slowly but steadily again. However, in our strategy, the price falling below the lower deviation band is a clear sign we should stop, so we are happy with this trade as is.
These two other trades show the best aspect of keeping a tight stop. 14 plus 8% profits, even when exiting the trade via the managed stop.
These two trades are worth looking into. Notice how weak the entry signal is. Yes, the price went above the upper deviation band in 2 consecutive periods. Barely. In both cases we are taking a position despite the fact that the previous candle closed at a loss. It seems like it's time to go back and fine-tune our entries. Same case here.
So, here we are, back with the final results. We have 66 trades, with 30 hits and 36 fails and a slightly lower ROI than before, at 144%. Not bad.
We will now do a little tuning and testing. We will start by tightening the situation in which we take positions.
Up until now, we were taking position once the price went above the upper deviation band for 2 consecutive candles. We will add a couple of new conditions.
First, we wish to take a position only if the current candle closes at a win, that is, candle close is greater than candle open.
We would also like to see that at least one of the last 3 candles closes above the upper deviation band. To do that, we will introduce the logical operator OR.
We will check if the current candle closes above the upper deviation band, or, if the previous candle closed above the upper band, or, the one before.
Let's see how the strategy performs with the new conditions. We will run the simulation and go straight to the end results.
As expected, we ended up with fewer trades. Only 52 this time, with a 50% hit ratio. The ROI seems to have suffered, going down to 110%.
To achieve the optimum balance, we would need to iterate several times, carefully looking into each trade to decide exactly what the best signals are.
We will stop here, and leave it up to you to keep tweaking your strategies until you are comfortable to trade live.